Welcome to Iron Financial. This is the place where we forge stronger portfolios by cutting right through the market's weakness. Today, we're putting on our hard hats because we are running a full-blown structural integrity test on a 155-year-old American giant, Campbell Soup. Now, this is supposed to be a foundational company, right? A name everybody knows, a stock you can build on. But lately, it is showing some major cracks in that foundation. So the big question for your portfolio is this. Are these just some surface-level cosmetic issues, or is this entire structure at risk of a total collapse? Well, we are about to find out.
And hold on, before we even look at the company's blueprints, the market is already sounding the alarm. Look at this number, down 3.6% in pre-market trading. That right there is the first tremor, the first sign of real damage. So what happened? What was the seismic event that caused this sudden weakness? What on earth is shaking a consumer staple giant like Campbell's right down to its core?
That's exactly right, and it's precisely why we're here. We are conducting a full, 6-stage structural integrity test to get to the bottom of this. Here's how we're going to break it down. First, we're going to pinpoint exactly where those cracks first appeared. Then, we'll get in there and gauge the real damage using the hard numbers. After that, we inspect the main pillars of the business to see what's holding up and what are the weak links. We'll analyze management's excuses. Are we dealing with some passing storms, or are there deep internal structural flaws? Then, and this is crucial, we look at their revised blueprint, the new guidance for the year. And finally, we deliver our final verdict. All right, let's get to work. Okay, let's dive right in. The event that sent these shockwaves through the market was Campbell's second quarter fiscal 2026 earnings report. Now, for a company that's supposed to be this steady, reliable, almost boring part of any defensive portfolio, this report was, well, it was anything but. It really exposed an aging foundation, and that's what prompted this entire deep dive analysis. This is ground zero. This is where those first fissures became visible for everyone to see.
All right, it is time to get our hands dirty and assess the initial damage. We're going to walk you through the headline numbers, and we're going to stack them up side by side against what Wall Street's architects were actually expecting. This is the raw, unfiltered data. It tells us just how bad the initial impact really was, so let's see how the actual structure compares to the plan.
We are starting right at the bottom line, profitability. The street was looking for 57 cents in adjusted earnings per share. Campbell's delivered only 51 cents. Now, a miss is one thing, but that's not the real story here. The real story is the sheer scale of the collapse year over year. You know, in the same quarter last year, they posted 74 cents. That means profitability didn't just dip, it absolutely plummeted by a staggering 31%. 31%. Folks, that is not a crack. That's a crater right in the middle of the company's earnings power.
And yeah, the problem isn't just about how much money they're keeping, it's about how much they're even bringing in through the front door. Just look at the top-line revenue. They were expected to bring in $2.61 billion in sales. They only managed $2.56 billion. So this tells me the issue isn't just about margins getting squeezed by inflation or supply chain costs. No, this is a fundamental demand problem. People are actually buying less of their products. And when the revenue foundation itself starts to crumble, the whole structure becomes dangerously unstable.
You are absolutely right, and you just hit the nail on the head, because this next number proves your point perfectly. This is organic net sales. Now, this metric is critical because it strips out things like acquisitions and currency fluctuations to show you the raw underlying performance of the core business. And look at it. Analysts were already bracing for a small contraction, about 1.3%, but the reality? A drop of 3%. The core business shrank more than twice as fast as even the most pessimistic forecasts predicted. This is a huge red flag that the brand's connection with its customers is weakening.
So let's just recap this initial damage report, because it's ugly. We're looking at significant misses on every single key metric. The earnings engine is sputtering, the revenue stream is drying up, and the core business is shrinking at a really alarming rate. These are not minor issues you can just patch up with a little spackle. Now, this looks like widespread, systemic damage, exactly. The surface-level cracks are far worse than they appear, and they're all pointing to much deeper problems. So now, we need to find the epicenter of all this damage.
You know, every large company is built on a few core pillars. For Campbell's, that structure basically rests on two main segments. You've got meals and beverages, that's your classic soups, your sauces, the stuff you think of first, and then you have snacks, which holds huge brands like Goldfish and Pepperidge Farm. To really understand the building's integrity, we have to stress test each of these pillars individually. And what we found is that one of them is under serious pressure. But the other one, well, the other one is on the verge of buckling completely.
And this table just illustrates the problem perfectly. Take a look at this breakdown. On one side, the meals and beverages pillar, the old guard, it's definitely under strain, no doubt about it. Organic sales are down 2% and operating earnings fell 15%. That's not good. But now, look over at the snacks pillar. I mean, this was supposed to be their future, right? The part of the business that's capturing modern, on-the-go consumers and driving all the growth. Organic sales dropped a whopping 6%. But here is the jaw-dropper. Look at the operating earnings, a 39% collapse. That is not a weak link. That is a catastrophic structural failure. The growth engine of the entire company is failing, and it's failing spectacularly.
And here we go, the official response from the top. Listen, when your CEO has to use the word stabilize, you know you are in a full-blown crisis. This quote is basically a direct admission that the snacks division is completely failing. But let's break down this corporate speak. What does decisive action even mean? Sharpening value sounds a lot like they're about to cut prices because they're losing. And new product innovation, isn't that something they should have been doing all along? So is this a real plan with actual steel and concrete, or is it just them slapping a fresh coat of paint on the wall to hide the fact that it's about to fall down?
Okay, so let's move on to the official explanation for all of this damage. Management has pointed to one primary external factor. They're telling investors that this was all caused by storm-related shipment disruptions. So, let's analyze this excuse. We have to ask, was this some freak weather event that temporarily damaged an otherwise solid structure, or is it just a convenient story to cover up pre-existing deep-seated structural flaws?
This is the core question right here, isn't it? I mean, are they seriously telling us that a 155-year-old company, a master of logistics that has survived multiple world wars, the Great Depression, you name it, was brought to its knees by a few snow days in January? It just feels thin. I'm extremely skeptical. So let's put this excuse to the test against their own numbers.
Management did, to their credit, put a number on it. According to their own press release, the total impact of these storms on their adjusted EBIT, that's their operating profit, was $14 million. That's their number. Now, I want you to burn that figure into your mind. $14 million. Let's put that into context.
And this is the slide where the entire excuse just completely falls apart. Look at this. The company's adjusted EBIT fell from $372 million last year all the way down to $282 million this year. So let's do some simple math. That is a total decline of $90 million. So let's be generous. Let's give them the full $14 million they're blaming on the weather. That still leaves a $76 million hole in their profits that has absolutely nothing to do with storms. The math here is undeniable. The storm is a smokescreen. It's a distraction from the fact that the core profitability of this company is eroding for much, much deeper reasons.
You know, in our analysis here at Iron Financial, the most damning piece of evidence rarely comes from past performance. It comes from what the company itself believes about its own future. And with Campbell's, their own revised blueprint for the rest of fiscal year 2026 tells you everything you need to know. They are flat out admitting that the damage isn't temporary, they know it's systemic.
Let's really break down this lowered guidance, because this is where the demolition happens. First, look at organic net sales. Their old blueprint, their old plan, allowed for the possibility of 1% growth. The new blueprint says unequivocally the business will shrink. There is no longer any expectation of growth for the entire year. And then you look at the profit engine, the EBIT. They were previously guiding for a drop of between 9 and 13%. Now that's bad, but it's manageable. Now, they're forecasting a decline of 17 to 20%. They're openly telling the market that their profitability is getting worse much, much faster than they thought just a few months ago. But the real demolition job, the thing that gets the wrecking ball swinging, is on adjusted EPS. They took their forecast from a range of 240 to 255 all the way down to 215 to 225. This isn't a minor adjustment. This is a complete reset of expectations that signals deep, persistent operational challenges ahead.
So, we've reviewed the quarterly report, we've inspected the damage, we've tested the pillars of the business, and we've completely dismantled management's excuses. We have seen their own bleak blueprint for the future. So, with all the evidence presented, it is time for Iron Financial to issue a final verdict on the structural integrity of Campbell Soup's stock. Now, to help with our verdict, we're bringing in a third-party data set from our partners at Smart Karma. Their Smart Scores rate a stock on 5 key factors, and what you see here, well, it's the definition of mediocrity. Value, meaning how it's priced, is just a 3 out of 5. Growth, its potential to expand, also a 3. Resilience, its ability to withstand a downturn, and momentum, the recent trend in its stock price, both a 3.
There is absolutely nothing here that screams strong buy. The entire profile is just average. With one glaring, powerful exception, and there it is, the Dividend, a perfect 5 out of 5. This is the one solid, high-grade steel beam in this entire rickety structure. This company is a reliable machine for paying out cash to its shareholders. No question. So the ultimate question for any investor looking at this stock becomes brutally simple. Is this single, powerful support beam enough to hold up a building that is clearly and demonstrably crumbling all around it?
Okay, let's summarize the key findings from our structural analysis. First, the Q2 results were a massive miss across the board. Earnings, revenue, core growth, they all failed to meet expectations. Second, the snacks division is, without a doubt, the primary structural weakness. A 39% collapse in earnings is a 5-alarm fire in that part of the business. Third, management's storm excuse is a smokescreen. The numbers clearly show it doesn't even come close to accounting for the majority of the profit decline. Fourth, the sharply lowered full-year guidance is basically an admission from the company that these problems are deep and they are going to persist. And finally, the only truly standout positive, the one pillar that's still holding strong, is that top-tier dividend score.
Which brings us to our final question for you. For your portfolio, is Campbell's a solid, high-yield foundation for an income-focused strategy, or is it a dangerous value trap where that fat dividend is just the last thing to go before a total collapse? Is this an opportunity, or is it a full-on portfolio demolition job just waiting to happen? Here at Iron Financial, our mission is to run the stress tests and give you the unvarnished analysis. The final decision on whether to build on this, hold your position, or tear it down, that is yours. Forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with